Ratio analysis. I am explaining ratio analysis part 1. Okay, my name is Venkat Durgara. If you like my class, please subscribe video channel. Okay, so let us explain the ratio analysis part 1. Formulas will be explained in the part 1. Again part 2, part 3, part 4, part 5 will explain the problems. Up to 15 to 20 problems will be explained in the different parts. Okay, so if you want to see the ratio analysis formulas, ratio analysis part 1. Okay, problems part 2, part 3, part 4 will be available. Okay, next, ratio analysis is one of the most powerful tool of financial analysis. So ratio analysis means it is expressing the two items between the either percentage or in the ratio or in the times. It will be explained. It means, for example, current assets is 1 lakh and current liabilities are 50,000. It means current liabilities is less than the current liabilities. It means current assets are more than the current assets. One time is more than the current assets. So it is a relation explaining between the two items. Okay, for example, sales is 10 lakhs, profit is 2 lakhs. 10 lakhs sales, the profit is 2 lakhs. The percentage will be calculated 2 lakhs by 10 lakhs into 100. 20% is profit. Net profit will be 20%. Okay, so remaining 80% is the cost of goods sold. 80% is cost of goods sold and operating expense will be calculated. So in this chapter we will calculate the problems is depending upon the formulas. Okay, so you must be clearly explain all the formulas and you have to by heart or learning the formulas. Okay, ratio is a simple arithmetical expression of the relation between the one number to another number. So it is all numerically that I will be explaining. Okay, compare between the two items. For example, A is to B, the ratio current assets by current liabilities times stock turnover ratio, debtor turn, how many times we purchase the stock, how many times will be given the credit facility to debtors, how many times will be amount payable to the creditors in a 1 year. So our percentage, gross profit percentage, net profit percentage, cost of goods sold percentage, expenses percentage will be calculated. Okay, so we are explaining the formulas each and every one with clearly and writing and also explaining. Okay, so let us see the formulas. Profitability ratios. First one we explain the profitability ratios like gross profit ratio, net profit ratio, operating profit ratio and expenses ratio will be explained. So first one is gross profit ratio. Gross profit ratio means gross profit by net sales into 100. Gross profit ratio equal to gross profit by net sales into 100. If you have to find out the gross profit, if it is directly given, there is no problem. If it is gross profit is not given, we also find out net sales minus cost of goods sold. Net sales minus cost of goods sold will get the gross profit. Okay, if net sales is also not given, then it should be find out in two ways. Cash sales, credit sales will be added minus sales returns. Depending upon the information, we have to find out the points. Okay, or total sales minus sales returns. Then we get the percentage. The gross profit formula is gross profit by net sales into 100. Okay, so gross profit equal to net sales minus cost of goods sold. So net sales equal to total sales minus sales returns or cash sales plus credit sales minus sales returns. Okay, so next point is net profit ratio. Net profit ratio. Net profit ratio equal to net profit by net sales into 100. Net profit ratio equal to net profit by net sales into 100. Okay, next one, operating ratio. Operating ratio means total expenditure of a product will be calculated. Okay, cost of goods sold plus operating expenses, it means cash expenses, okay, by net sales into 100. So cost of goods sold, you have to find out the cost of goods sold if you need. Opening stock plus purchase plus direct expense. Direct expenses means trading account debit side unde expenses annamata. Ante like factory expenses, factory wages, all expenses are direct expenses minus closing stock. Okay, opening stock plus purchase plus direct expenses minus closing stock, we will get the cost of goods sold. Okay, next In another way, we have to find out the cost of goods sold easily. Sales minus gross profit. Sales minus gross profit also. It means we can find out the cost of goods sold. Okay. Next, operating expenses. Operating expenses like profit and loss account debit side given expenses, like only cash expense will be taken. Only cash expenses like office expenses, administration expenses, selling expenses and distribution expenses. For example, salaries, printing, stationery, postage, telegram, advertisement, traveling expenses. All expenses will be added to the operating expenses, but not the non-operating expenses like depreciation, bad debts should not be taken. Okay, so cost of goods sold plus operating expense by net sales into 100. We'll get to the operating ratio. Okay, operating ratio will be get. Okay, next point. Operating profit ratio. Operating profit ratio equal to 100 minus operating ratio. In the previous formula, we explained the operating ratio. If you get 80% in the operating ratio, the operating profit ratio will be at 100 minus 80%. So we will get 20%. If you get operating ratio is 86%, you get the operating profit ratio is 14%. Okay, expenses ratio. If you ask in examinations, expense ratio means we find out all expense ratios will be found. For example, office expenses. Office expense by net sales into 100. Material consumed expense ratio. Material consumed by net sales into 100. Administration expenses. Administrative expense by net sales into 100. Okay. Next, selling expenses. Selling expenses by net sales into 100. We will calculate the expense ratio means 2-3 formulas will be calculated. If you particularly asked, for example, office expense ratio is asked, office expense by net sales into 100. Okay, if expense ratio will be asked, we will calculate 2, 3, 4 expenses ratios will be calculated. Okay, next point will be taken. Return on capital employed. How much capital invested in the business and what profit will be acquired. It will be calculated in the percentage form. Okay, return on capital employed equal to operating profit by capital employed. Operating profit or earning, EBIT means earning before interest and tax. Okay, so here operating profit will be directly given in the question. Okay, capital employed, in what way we have to find out. Capital employed equal to equity share capital, preference share capital, profit and loss account, reserves and surpluses which are in the liability side. Okay, plus long term liabilities will be taken. Okay, less fictitious assets if any in the asset side, like preliminary expenses, discount on shares, discount on debentures are given in the asset side. You should be eliminate. Non-business assets also will be eliminate. We will get the capital employed. Once again I will explain: equity share capital, preference share capital, profit and loss account, reserves and surpluses, plus long term liabilities will be added, minus fictitious assets, minus non-business assets will be deducted. Or in the other way, we have to find out fixed assets, intangible fixed assets, current assets will be added, minus current liabilities will be deducted. We will get the capital employed. Okay, this is the way to calculate the formula. We should have to note down the each and every formula and learn very thoroughly. We get the kept formulas in the mind. Okay, then only we'll do the problems easily. Ratio analysis is a big chapter for degree students or CA, CMA students will be, all our persons will be useful. Solvency ratio. Solvency ratio, sir, will be explained now. Current ratio. Current ratio means current assets by current liabilities. Current assets by current liabilities. Okay, here will be 2:1. Current ratio must be 2:1. If 2:1, the company's solvency position is better. In what items, what are the items will be come under the current assets? What are the items will be come under the current assets will be explained. Cash, bank, stock, debtors, bills receivable, prepaid expenses, accrued incomes, short-term investments, short-term loans and advances are come under in the current assets. Cash in hand, cash at bank, Short-term investments are marketable securities. Short-term investments are marketable securities. Nothing but short-term investment. Bills receivable, trade debtors, short-term loans and advances, closing stock, prepaid expense are common in the current assets. Whereas current liabilities like creditor, bills payable, bank overdraft, outstanding expenses, provision for tax, proposed dividend, unclaimed dividend, next income received in advance. Those are the items will be come under in the current liabilities. If the current liabilities are 1 lakh, current assets are 2 lakhs, the company solvency position is better. Okay. Next one, absolute liquid ratio will be explained. Solvency ratios another formula will be explained. Liquid ratio or quick ratio or acid test ratio. Liquid ratio on quick ratio on acid ratio on okate. Liquid assets by quick liabilities or liquid liabilities. Okay, so liquid assets means easily convertible into cash or in kind. So current assets, total current assets already explained in the previous formula, minus stock minus prepaid expense. Total current assets will be taken less stock and prepaid expense will be deducted. Okay, or two items will be related in the current assets, remaining assets will be added. Quick liabilities, current liabilities minus bank overdraft. Those are the 2 points. Here quick ratio is the 1:1 will be have, then it is a solvency position. Okay, next another formula, absolute liquid assets. Absolute liquid assets ratio or absolute super quick ratio or absolute liquid assets. The formula is absolute liquid assets by quick liabilities or liquid liabilities. If liquid liabilities is not available, current liabilities will be taken. Absolute liquid assets like exactly cash items will be, and cash and equivalent items will be taken. Cash, bank and short-term investments or short-term marketable securities, both are same. The 3 items will be added, then it is called absolute liquid assets by liquid liabilities or current liabilities will be taken. Okay, next formula explain. Inventory to working capital. Inventory to working capital means inventory by working capital. Inventory to working capital means inventory by working capital. Inventory means stock, it means closing stock will be taken. Working capital means current assets minus current liabilities. Okay, current assets minus current liabilities is the working capital. Next, turnover ratios. Turnover ratio means how many times will we purchase the stock. Okay, how many times, data turnover ratio. How many times will be collected in the 1 year amount. Creditors turnover ratio. How many times will pay the payment to the creditors. Like those formulas will be calculated under turnover ratios. First one, stock turnover ratio. Stock turnover ratio are also called as the stock velocity. Okay, is equal to formula cost of goods sold or net sales. If we have cost of goods sold will be taken as the first preference. Okay, if the not possible to find out the cost of goods sold, then we will take the net sales. If both cost of goods sold, net sales is available, then only take the cost of goods sold is a first priority, then the net sales. Okay, next average stock. Average stock means availability of information. If closing stock, opening stock both are available, then opening stock plus closing stock between add to, they divided by 2. Okay, is the average stock will be taken. If there is no information like opening stock, then will be taken closing stock directly. Okay, depending upon the information we will follow the formula. So cost of goods sold by average stock. Okay, net sales by closing stock, whichever will be taken. If closing stock will be available, then only take the cost of goods sold. Okay, there is no opening stock, the closing stock will be taken. The answer will be explained in times. If 3 times, 4 times, 5 times, the 3 times will become 3 times. It means the stock will be purchased in 1 year in 3 times. It will be explained in the days. is called stock conversion period. Stock conversion period means how many days will purchase the stock will be maintained. So 1 year will have 365 days by stock turnover ratio. So the above formula value will be substituted. 3 times have been taken. It means 90 days, 91 days, 92 days will be come, and for every 3 months will be purchasing the stock and maintenance in the stock. It is the stock conversion period. Okay, 365 days. If not given in the problem, if some problems they are given 360 days will be given, then we take the 360 days by stock turnover ratio. Okay, next formula will be explained. Debtors turnover ratio. Debtors turnover ratio or receivable turnover ratio. Formula: net credit sales by average trade debtors. Net credit sales by average trade debtors. It will be expressed in terms of times. Okay, it means that amount received from the debtors will be taken how many times in a year. Okay, the net credit sales we will find out as total sales minus sales cash sales. Will get the net sales, net credit sales. So then credit sales minus sales sales will get the net credit sales will be counted. Okay. Next, the average trade debtors. The average trade debtors equal to, it means if 2 years information is available, then we will be taken as a average. If there is only 1 year information, we will be take as a trade debtor. Okay, the average trade debtor will be taken whenever the 2 years information will be available. It means opening trade debtors plus closing trade debtors by 2. Okay, opening trade debtors plus closing trade debtors by 2. Trade debtors equal to, it means trade debtors equal to sundry debtors plus bills receivable. Sundry debtors plus bills receivable will be taken. Okay, debtors collection period. Debtors collection period 365 days by debtor turnover ratio. The above formula value will be substituted. It will be expressed in the days, 90 days, 75 days, that 3 months will be expressed in the days. Okay, this is the debtor collection period. Next will be explain the creditors payment period and creditors turnover ratio. Creditors turnover ratio or account payable ratio is formula: net credit purchase by average trade creditors. Net credit purchase by average trade creditors. The expression times only. Net credit purchase will be find out total purchase minus cash purchase will get the credit purchase. Credit purchase minus purchase returns will get the net credit purchase. Okay. Next, average trade creditors. If 2 years information is given in the problem, then only will be the average. If 1 year information will be given, creditor plus bills payable. Okay. So average trade creditors equal to opening trade creditors plus closing trade creditors by 2. So here trade creditors equal to sundry creditor plus bills payable will be taken. Okay. Next, creditors payment period. Creditors payment period means how many days will be taken to lag for payment of the creditors. Okay, 365 days by creditors turnover times will be taken, expressed in the days. Okay. Next formula explain. Working capital turnover ratio. Working capital turnover ratio equal to formula cost of goods sold by average working capital. So cost of goods sold will be explained in the previous formulas in the gross profit ratio. Okay, average working capital means opening working capital plus closing working capital by 2. Working capital means current assets minus current liabilities. Average will be calculated whenever the 2 years information only available. If there is only 1 year information, we will show the working capital. Okay. Next formula debt equity ratio. Debt equity ratio means long term debt by shareholder funds. Long term debt equal to, it means long term liabilities, debentures, mortgage loan, bank loan, loan from financial institutions will be taken, and also will be taken as current liabilities. So outside liabilities will be taken. Long term debt or outside liabilities will be taken. Okay. Next, shareholder funds. Shareholder funds means equity share capital, preference share capital, profit and loss account, general reserve fund minus fictitious assets will be deducted from the shareholder funds. Okay, then we will get the shareholder funds. Long term debt by shareholder funds will be taken. Okay, we will explain the next formula. Okay, ratio of current asset to fixed assets means current assets by fixed assets. Proprietary ratio, shareholder funds by total tangible assets. Okay, capital gearing ratio, fixed interest bearing securities or long term liabilities by equity shareholder funds will be taken. Capital gearing ratio. Okay, next remaining formulas will be explained. Okay, leverages ratio explained here. Sales, this format will be in the marginal costing also. Sales minus variable cost will get the contribution. Contribution minus fixed cost will get the profit. So it is called earning before interest and tax minus interest on debentures will be less. Then we will get the earning before tax minus less tax. Then we will get the earning after tax or net profit. Okay, this is the statement. So we have to calculate the formulas. Operating leverage ratio, it means contribution by EBIT. Contribution by EBIT means earning before interest and tax. Financial leverage, earning before interest and tax by earning before tax. So EBIT by EBT will be taken. Okay, composite leverage or combined leverage means operating leverages into financial leverages into answer. Okay, it means contribution by EBT. Okay, contribution by EBT will be directly taken. ROL into FL will be taken. Okay, next one, return on net worth. Net worth or shareholder funds are both are same. Net profit after interest and tax. It means here earning after tax. Okay, net profit will be taken. Net profit by shareholder funds into 100. Okay, next return on equity shareholder funds. It means after parenting of, so here net profit after tax, it means minus dividend on preference share capital. Dividend on preference share capital less. So amount profit to net profit to equity shareholders. Okay, so net profit after interest, after tax, after dividend. So by equity shareholder funds. Okay, return on total assets. Net profit after tax. So net profit after tax before the dividend will be taken by total assets into 100. Okay, so please learn formulas, then only sums will be understand very easily. Without knowing formulas, without keeping formulas in our mind, we should not do the problems easily. So it is a very important chapter for all sections. Okay, if you like my class, please subscribe our channel. Thank you for watching. So my channel is VDR channel. Okay, is a ratio analysis part 1. Problems will be explained in the ratio analysis part 2, part 3, part 4 will be explained in continuously. Thank you for watching this class.